Hey everyone, and welcome back to the Safe, Simple Sound podcast. I'm your host, Alex. Here, our mission is exactly what it sounds like. We want to guide you toward financial freedom using strategies that are safe, simple, and sound. A huge part of our philosophy, specifically the S in our secured framework, is about seizing financial control. And let's be honest, nothing makes a business owner feel clearer and more in control than getting rid of that overflowing shoebox of crumpled receipts. Today, we're diving deep into the logistics of that process. This episode will be a fantastic guide for any entrepreneur or freelancer looking to transition to paperless business records without losing sleep over an audit. If you are ready to declutter your office while keeping your business strictly compliant, this is the episode for you. Let's get into it. Now, I know the dream. You want to take that shoebox full of crumpled receipts, scan it all into the cloud, shred the paper, and live that sleek, paperless business records lifestyle. It sounds amazing. But before you fire up the shredder, we need to talk about exactly what the IRS expects from you when you go digital. Because, spoiler alert, the rules don't disappear just because the paper does. We need to establish the golden rule of IRS digital record-keeping. It's actually pretty simple. Your digital systems must adhere to the exact same standards as traditional hard copy books. There is no light version of compliance just because you're using an app. You cannot cut corners just because the format is modern. If an auditor can't read it on paper, they definitely can't read a blurry photo on your phone. So, what does a compliance system look like? It's not just a folder on your desktop named tax stuff. To satisfy the IRS, your electronic system needs 5 non-negotiable capabilities. First, it has to index. That means your files are organized and searchable. Second, store. The data has to be secure. Third, preserve. No data corruption over time. Fourth, retrieve. You need to be able to find it fast. And fifth, and this is the big one, reproduce the data in a legible format. Think of it this way. Does your current digital storage method actively index your files? Or are they just sitting in unstructured folders? If you're just dragging and dropping random screenshots into a Google Drive without a naming convention, you aren't indexing, you're digital hoarding. And that won't fly during an audit. The overarching requirement here is that your system must provide a complete, accurate, and accessible record for IRS inspection at any time. Now let's talk timeline, because this is a common question. How long to keep digital business records? Just because digital storage is cheap doesn't mean you keep everything forever, but you also can't delete files just to clean up your hard drive. You need to follow the electronic record retention guidelines based on the period of limitations. Generally, that is 3 years from the date you file your return. However, if you substantially underreport your income, we're talking more than 25 cents, that statute of limitations stretches to 6 years. I want you to take a second and reflect on your own setup right now. If the IRS audited you today, this afternoon, could you instantly retrieve and reproduce a legible record from 3 years ago? Not find it eventually, but retrieve it instantly? If the answer is maybe or I think so, we need to tighten that up to create truly audit-proof records. So, here's your call to action for this segment. I want you to do a retrieval test. As soon as this episode is over, go to your digital storage. Pick a random business expense from exactly 3 years ago. Try to find it. Open the file. Is it corrupted? Can you read the vendor name? Can you read the date? If you can't, your system needs an upgrade before you destroy any more paper originals. All right, we just wrapped up the golden rule in our last segment, establishing that if you're going digital, your electronic files have to be just as accessible and reliable as that dusty stack of papers in the corner. That is the foundation. But now let's get to the fun part, or at least the part that clears off your desk. We are moving into going paperless, software selection and scanning protocols. If you are like most of the business owners we talk to, you are dying to get rid of the clutter. You want to embrace paperless business records because, let's be honest, shoeboxes are for shoes, not for tax compliance. But before you fire up the shredder, we need to talk about the tools you're using and the safety checks you need to have in place. First, let's talk about the gear. Whether you are browsing the App Store for receipt scanner apps or looking at a robust desktop platform, you need to know that the IRS doesn't endorse specific brands. They don't have a favorite app. Instead, they have criteria. Think of it like buying a car. The government doesn't care if you drive a Ford or a Toyota, but they do care that it has working headlights and passes a smog check. For your accounting software, you are looking for the big 3 features. Number 1 is legibility. Can you actually read the scan? If your app takes blurry photos where a 3 looks like an 8, that is a compliance failure. Number 2 is traceability. Can you look at an entry in your ledger and trace it all the way back to the original source document? And number 3 is reconciliation. Does the data in your software match what ends up on your tax return? If your system can't do those 3 things, it's not a record-keeping system, it's just a digital trash can. Now, here is the curveball that catches almost everyone off guard. It's called the documentation requirement. Did you know that to be truly compliant with IRS Digital Recordkeeping, you are required to have a written description of your system? It sounds bureaucratic, I know, but you essentially need a user manual for your own business finances. You need to document how the data flows, what controls you have to prevent someone from deleting files, and how your chart of accounts is set up. Ask yourself right now, have you documented the specific controls and procedures your business uses to prevent unauthorized changes to your digital records? If I asked you to show me your standard operating procedure for scanning a receipt, could you do it? This brings us to the question I know you're Googling. Can I throw away receipts if I scan them IRS? The answer is yes, but with a major asterisk. You can only destroy the original hard copies after you have tested your system. You need to prove that your digital process is accurate and that the images are high quality. This is how you create audit-proof records. You cannot just assume the app is working. You have to verify it. Imagine you're skydiving. You don't just pack the parachute and jump, you inspect it first. Destroying your physical receipts is the jump. If your digital backup fails or your hard drive crashes and you've already shredded the paper, you have no parachute. This leads to the risk factor. Equipment failure happens. Cloud services have outages. Before you go fully paperless, you must verify your backup capabilities. Are you 100% confident that your digital system has been tested enough to justify destroying your physical source documents? If there is even a 1% doubt in your mind, keep the paper a little longer. So let's recap how to do this safely. 1. Choose software that guarantees legibility, traceability, and reconciliation. 2. Don't ignore the documentation requirement. Write down how your system works. 3. Test your scanning process rigorously before you destroy a single piece of paper. 4. Ensure your backups are bulletproof to avoid data loss. Here is your homework for this week, and it's a vital one. I want you to draft a simple 1-page document describing your accounting workflow and data backup procedures. This will satisfy that IRS documentation requirement. Just write down Step 1, receive invoice. Step 2, scan to cloud. Step 3, verify image clarity. Step 4, backup to external drive. Keep it simple, but get it in writing. Now, once you have your scanner whirring and your software humming, you might think, great, I have the scan and I have my credit card statement, so I'm double covered. Well, not exactly. Before you fire up that shredder, we need to talk about a specific danger zone. I call it the verification gap. This is where we see so many smart business owners stumble. We're going to talk about the massive difference between a bank statement and a source document. Here's the common myth I need to debunk right now. There is a belief out there that says, I don't need to keep that crumpled little receipt because the charge is listed right there on my credit card statement. The IRS can see I spent $200 at Office Depot. It's right there in black and white. I hate to be the bearer of bad news, but that line of thinking, it's a one-way ticket to a headache during an audit. Here is the reality. A bank statement or credit card statement serves as proof of payment. It proves that money left your account and went to a vendor. That's it. It does not serve as proof of a business expense. Let me give you a real-world example to make this stick. Let's say an auditor is looking at your business expense tracking for last year. They see a charge on your credit card statement for $500 at a big electronics store. Let's say Best Buy. The statement shows the proof of payment IRS requirements. It has the payee name Best Buy, the transaction date, and the amount posted. Technically, that proves you paid Best Buy $500. But here is the gap. That statement doesn't tell the auditor what you bought. Did you buy a new monitor for your office design work, or did you buy a PlayStation 5 for your living room? From the bank statement's perspective, those two transactions look exactly the same. But from a tax deduction perspective, one is a valid expense, the other is a personal toy. This is why you need the source document. The source document is the itemized invoice or the sales slip. It fills that verification gap. It lists the SKU, the item description, and the quantity. It proves that the $500 went toward a business asset, not a personal luxury. So, thinking about your own habits, are you relying solely on your credit card statement to explain your business expenses to an auditor? If you are, you're vulnerable. For those of you using electronic funds transfers (EFT), the rule is the same. The IRS says your statement must show the amount, the payee, and the date. That's great for proving the transaction happened. But to prove it's a deductible business expense, you must have that underlying invoice that links the payment to a specific business activity. Think of it this way. The bank statement answers who, when, and how much. The receipt answers what and why. You need all five to be audit-proof records. Does your current record-keeping process link the proof of payment directly to the itemized invoice? If you're using software like we discussed earlier, usually you can snap a photo of the receipt and attach it directly to the transaction line imported from the bank. That is the gold standard. That closes the gap. So let's wrap this up with a summary of what we've covered today. First, digital records must follow the same rules as paper. They need to be legible, retrievable, and indexed. Second, don't destroy your paper originals until you've tested your system. And finally, never assume a bank statement is enough. You need the itemized receipt to prove the nature of the expense. Here is my challenge for you this week. Your call to action. I want you to open up your accounting software or your banking app, review your last month's credit card statement, pick 3 random business charges. Now, go find the corresponding itemized receipt for those 3 charges. If you can find them in under 2 minutes, you're winning. If you can't find them at all, or if you realize you threw them away because it's on the statement, it's time to tighten up that workflow. And that brings us to the end of this guide on mastering IRS digital recordkeeping. I know tax compliance isn't usually the most exciting part of being a business owner, but as we've seen today, getting this right is the bedrock of keeping your venture safe. We covered a lot of ground, starting with the golden rule of compliance, ensuring your digital system adheres to the exact same standards of indexing and retrieval as traditional books. We also discussed the critical timelines for electronic record retention and why you simply cannot rush to shred those paper originals until you've rigorously tested your backups. Perhaps most importantly, we close the gap on IRS receipt requirements. If you take one thing away from this episode, remember that verification gap. A credit card statement is merely proof of payment, not proof of a business expense. You need those itemized source documents to maintain truly audit-proof digital tax records. Transitioning to paperless business records is a fantastic way to declutter your workspace and seize financial control, the S in our secured framework, but only if you execute it with the right safeguards. Thank you so much for tuning in and trusting me with your time today. If you want to review the summary checklist for compliance we discussed, head over to the show notes at safesimple.sound.com. And if this episode saved you from throwing away a receipt you shouldn't have, please consider subscribing and leaving us a review. It helps us reach more business owners just like you.